Kohls is one of the largest department stores. It has thousands of stores in the USA. It has a store in every state. The only store in the US that doesn't have a Kohls department store is Hawaii. Inflation hasn't been kind to Kohls. Kohls stock price is at a 10-year low. They've underperformed the S&P 500 and their retailer peers throughout the years. In the recent quarter ending July 2022, Kohls' net income was $143, a drop of 60% compared to the same time last year, while comparable store sales dropped by 7.7%. Revenues were down by 8% as well. Inflation is eating away at consumer spending power at retailers. Fuel, food, and grocery costs are skyrocketing. People have less money to buy clothing and goods when they're trying to save money. Less shoppers are coming to Kohls stores, and plenty of inventory went unsold as a result. Kohls was forced to launch a slew of promotions and discounts to clear out their excess inventory. Kohls was also forced to reduce operational costs and cancel orders from suppliers. Customers would rather shop at cheaper places like Dollar General. Kohls had been one of the victims of the pandemic shutdown. Without customers shopping at their physical locations, their revenues plummeted. Last year, Kohls' financial troubles attracted bloodhounds from the activist investor world. Kohls was attacked by this group of activist investors which tried to replace the company's board of directors. McCallum Advisors and Cora Holdings and 4010 Capital LLC and Legion Partners own a combined stake of 9% in Kohls. They had wanted to replace 9 out of the 12 board members to gain influence in the company's decision-making. Activist investors made demands to Kohls company heads, asking the company to hire more directors with retail experience, lease $7 billion worth of Kohls' non-core real estate, and reduce inventory levels while improving discounts and product offerings. At the end, both Kohls and the activist investors compromised and added 3 new board members instead. Near the end of the year 2021, as a sign of things to come, one hedge fund called Engine Capital urged the retailer to sell the company off to unlock shareholder value, or at least consider separating its e-commerce business. By splitting out, Kohls businesses wouldn't change much. It would only mean more investors would want to buy into the e-commerce side of the business, which is one of the fastest growing segments of the Kohls company. Activist investors believe that more investors would willingly buy shares of Kohls' faster growing e-commerce business, especially when it isn't bogged down by its slowing brick-and-mortar retail segment. Kohls obviously doesn't want to be bought out. Unfortunately, the buyout movement gained traction the following year. In January 2022, activist investor McCallum Group successfully forced Kohls to make a reluctant attempt to sell the company. Kohls was forced to hire Goldman Sachs to entertain interested buyers. It received over 20 offers from interested parties. Kohls is desirable to buyers because it owns more than 30% of the property its stores are housed in, a rarity in the retail industry. This means they save money by not needing to pay too much rent. Earlier in the year, Kohls received an offer by Acacia Research, backed by activist investment firm Starboard Value, which offered to pay Kohls $64 per share for all the shares they owned. That's 37% more than what the stock was worth at the time, for a $9 billion valuation. In February 2022, after reviewing the offer, Kohls said the buyout offer was too low. The buyers were undervaluing their company, so Kohls enacted a poison pill strategy, a strategy that's not too different from what Twitter employed against Elon Musk's attempt to stage a buyout. The poison pill was supposed to ward off activist investors like McCallum from buying more than 10% of the Kohls company. McCallum Advisors said that Kohls CEO's efforts to grow revenue have failed and they need to take charge of the company in order to unlock shareholder value. McCallum Advisors' attempt to buy out Kohls company shares failed. The poison pill makes it difficult for activist investors to buy more than 10% of the company's shares because after the 10% threshold, existing investors would be able to buy Kohls shares at a 50% discount. However, like all poison pill strategies, the activist investors who triggered the poison pill would not be allowed to buy the stock at the same discount. This means a share dilution would be triggered specifically for activist investors who tried to buy more than 10% Kohls shares. Kohls did this to stop a buyout vote from passing. It doesn't want McCallum Group to replace its 10 board members. Without the 10 board members, McCallum can't stage a takeover of the Kohls company. Kohls managed to win its proxy fight against activist investors using its poison pill strategy. McCallum Advisors failed to replace 10 out of Kohls' 14 board member seats. They were stuck with the 3 board members which they had placed in the company previously. In June 2022, Kohls received bids to buy out the company from Franchise Group. Franchise Group offered more money and offered to buy Kohls at $60 per share, hinting at a roughly $7 billion valuation. This valuation is actually lower than the offer that Kohls received from Acacia Group, which offered to buy the company at $63 per share, which they rejected. If $63 per share were not enough, then $60 per share was a no-go. Kohls wanted $70 per share if any anyone wanted to buy out its company. Franchise Group already owns retail companies like Pet Supplies Plus and Vitamin Shop. In the end, Kohls rejected the buyout offer because Franchise Group chickened out at the end, lowering their offer to $53 per share because they were not confident about Kohls retail businesses in the current economic climate where signs of a recession were taking hold. Franchise Group also revealed that they would have had to sell some of Kohls' own property assets and borrow money to complete the Kohls buyout. This type of deal would only end in disaster. The last company which tried to sell their real estate assets and take on debt to buy a company went bankrupt. Sears, Mervyn's, and Toys R Us went bankrupt using this strategy. By selling Kohls' real estate, Kohls would need to rent its locations. The rent it would have to pay for its hundreds of stores would waste too much of its resources and could force it to borrow more money, which leads to excessive debt. Kohls' management also knew that the franchise group didn't have the necessary expertise or skills required to change Kohls' business model for the better, so Kohls had to reject the buyout offer. The activist investors were not happy with the situation, but no one else wanted to buy Kohls when the outlook for retail was gloomy. Kohls actually had to revise its projected earnings to reflect a weaker economy. After rejecting several buyers, Kohls' buyout offers dried up. In the company's defense, Kohls is trying its best to survive. It joined forces with Amazon years ago to accept Amazon shipping returns of disgruntled customers for free. The company did this so it could boost foot traffic to Kohls department stores. The hope was customers would come to return their Amazon purchase at Kohls department stores, and when they were enticed by Kohls offerings, customers would accidentally decide to buy something from Kohls department store. Kohls also managed to snag a deal to sell Amazon's Echo and other electronic devices in Kohls stores. The move was controversial to be sure, but Kohls couldn't be picky with its methods. Most shoppers are online nowadays. It had to attract shoppers to its stores somehow. If it meant doing Amazon's dirty work for free and accepting Amazon returns, so be it. This is not the only strategy that Kohls has up its sleeve. Kohls is also working with Sephora, a popular fashion brand and online retailer, to set up over 1,000 Sephora shops within Kohls department stores locations by the end of 2023. Kohls expects its business partnership with Sephora to add 10% more revenue and generate $2 billion by the end of 2022. This move doesn't come without risks. Ulta Beauty, a Gen Z beauty brand, is also planning to open more than 100 stores in another more popular retail chain, Target. This Sephora strategy has a history of failure. Another retailer, JCPenney, had Sephora stores in its many department stores, and it still failed to make enough money to avoid bankruptcy. JCPenney actually filed for bankruptcy in 2020 and closed many of its stores, so Kohls has to work hard to make the Sephora thing work. Beauty has always been an underdeveloped category in Kohls department stores, so management is positive that their Sephora store strategy will fill in the gap and generate revenue hopefully. Kohls is also planning to open 100 new smaller stores after its pilot runs showed promise. Kohls is doing all it can to raise profits. In the end, Kohls is still a solid company. If they are able to weather the current downturn, then in the long term, their finances will improve.